Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Marty. It's great to have you on the podcast. I've been looking forward to this for a while now.
Well, Bilal, it's absolutely my pleasure. I'm grateful for the invitation, and am a big fan of your podcast. You've got a really interesting and, may I say, eclectic group of speakers that you get on, and that always makes it interesting. So thank you for doing it.
No, great. I appreciate that. Now, as you know from my podcast, I always like to delve a bit deeper into somebody's origin story before we get into the meat of our conversation. So it'd be great to learn a bit more about your origin story. What you studied at university. Was it inevitable you'd end up in finance, which I suspect from your background it may not have been, and then some of the highlights of your career up until now.
Yeah, well, it certainly wasn't inevitable that I'd wind up in finance. I studied physics, and clutching my undergraduate degree in physics, I wound up with two job offers. One was as a systems engineer at IBM with my love of technology, and the other, curiously, was as an equity salesman at Nomura. And gosh, I think Nomura offered me £500 a year more, so I went with Nomura. But I think apart from learning the language of finance, that gave me the opportunity to be in the city and to be just down the road from my friend Michael Adam, who was working for his father. And the Adam family was originally Mauritian. They had a sugar IB, a sugar broking business. And Michael's father handed Michael a book of chart methods, of technical trading models, and said, "Why don't you see if there's anything in this?" So, this was the early 80s. PCs were just beginning to become available. Mike bought an early Hewlett-Packard workstation and started coding up some of these technical trading models. And I was absolutely hooked. This just was both a fascinating computer problem, application, and a real world problem that we were both fascinated with. So I left my job after only 9 months at Nomura and joined the Adam family business and started developing systematic models in the futures markets. And really that Brockham Securities, Mike's dad's business, led the two of us to meet David Harding, who was also, he was actually a Cambridge physics graduate with a fascination of markets and chartism. He worked for a chartist fund manager when we met him. And the three of us put together this idea of systematizing trading rules, which became Adam Harding and Lueck, AHL. And then out of that became Aspect. But I'm sure we can go into that, Bilal.
Yeah, it's great. And just out of interest, Michael Adam, was his background physics as well? Were you all
Yes.
physicists?
Yep, we're all curiously physicists.
Okay, great. Okay, good. That's good. It's a great story, by the way. It's quite unusual as well. Well, I guess perhaps we can start with this whole idea of systematizing investment strategies versus discretionary. So, you could, caricature investing as the discretionary guys who use analysis and data, but they prefer to rely on their discretion, and don't want to rely on models. And then there's a systematic side. So, what do you think? Maybe I'll flip it around the other way. I mean, what do you think discretionary managers bring to the table that systematic managers miss out on, and then vice versa?
Well, I think humans are very good at seeing patterns and drawing inference across disciplines. So I take nothing away from human expertise, but and I'm a man with a hammer, so everything is a systematic nail. Really, right at that origin story I just told you, if you think about what David was excited by and what we were excited by was if you could encode the rule set that's actually going through the mind of a discretionary trader, that would give you such leverage. That would give you the power to test their thesis, to reparameterize their thesis, to improve on it, to create a baseline of what the rationale is for trades, and then to build from there. And once you see it in that light, the kind of, for me anyway, there was no going back. So of course, I realized that discretionary traders will assimilate a much more dynamic set of data, but then I'm always curious as to how can I systematize that, because that gives me the ability to capture it and to improve it.
Yeah, no, that's a great point. And I noticed on Aspect's website, you talk about the scientific. You mentioned science a number of different times, and you're a physicist by background as well. And in science, there's this tension between theory or explanation and empiricism.
Yes.
And I mean, how do you deal with that? Where do you let the data just talk, so to speak, or do you have a prior theory, or do you need to have an explanation of why something's working and then use the data to validate it or not?
Well, I get, if I'm being candid, I think this is an evolving science. I'm sure if you go to university today and to get your master's in quantitative finance, there will be a whole segment on the discipline of testing. We were kind of making it up as we went along, Bilal, and so first of all, positive feedback. In that origin story, AHL was acquired by Man Group, and Man had a fabulous success with another systematic trader, a CTA called Mint. And the Mint fellows had come up with a money management approach, which they systematized. It gave them scale, but they weren't scientists per se, and they weren't particularly driven to go and improve it, to keep researching it. So they had effectively a static model, which they ran very, very, very successfully, but gradually over time, the model deteriorated. And in the end, it turned out not to be as successful. And meanwhile, Man had acquired these 3 young men and a research effort that was predicated on what can we do better? How can we add more markets? How can we shorten the distance between sampling the markets and executing our trades? All of these curious and, with hindsight, obvious questions that you ask along the way. And it became successful. So there was positive feedback about applying a scientific method to this domain. And what that evolved into, if you ask the research teams at Aspect now, there is very much a discipline of, we are trying to articulate an underlying hypothesis. We're trying to do this properly and with rigor. So you must articulate what the underlying hypothesis is, and then seek to disprove it through your experiments, through your models. I'm saying, but finance is an imperfect science, Bilal. It isn't physics. So obviously many of these ideas and these hypotheses come to us through empirical evidence, through things that you find in the data or observations that the team will make or our clients make. And then there's the art, shall we say, of constructing the narrative, constructing the hypothesis. Why is it plausible? Why is it believable? What's the effect that you think you're harnessing here? But then we do apply rigor in the scientific method of looking for experiments that will disprove our hypothesis. Is that a
that makes sense? And I do agree. I mean, finance is an imperfect science. I mean, there is almost barely any sort of settled truths or anything. It's not like physics where there's some very robust theories that just hold multiple different dimensions. One question, I mean, I always have this, I mean, we at MacroHive, we do lots of quantitative research as well, and we always have this philosophical issue of when do you know when to switch a model off or to add a new feature to it, these kind of trade-offs that you have, because you don't want to overfit. And if the model's underperforming, it could well be within the distribution of the model. But at the time, we're humans. It doesn't feel like it if you're in the left tail of the distribution. It feels like the model's not working so well. So, I mean, how do you grapple with these issues?
It's a really hard one, and I would say there's no right answer, and it definitely, in our experience, is not a fully systematic process. And I'd say a lot of it comes down to experience and the sort of experience you allude to. The approach that we take is that in monitoring the breadth, all of the models across the business, and we've got multiple different teams looking for different styles of models, and so those different styles will have different properties. So there's a systematic discipline of how's the model doing compared to what you expected it to do, and that flags up models to watch. Okay, this one's on watch, and that will elicit a conversation. It won't necessarily elicit an automatic reduction or removal of the model, because then you're going to have it's the questions that you're raising. Is this in the realms of the distribution that I'd assume? Is the underlying hypothesis, again, is that still valid, or has the world changed? Or has this is much more common in terms of retiring models, is the information that was driving this model no longer valid, or no longer providing me with a benefit that it might have done at the time that I researched it and implemented it. And that it will be a discussion before we reach the conclusion that it's time to retire a model. And just making the observation that the earliest models that came out of the AHL story and the roots of Aspect are trend, and trend is quite a weak. If you look at it at a particular time scale on a particular model, that's not a high signal traction model. So you have to have real underlying confidence in the features that underpin that model to bear with it, to remain committed.
And in terms of, before we talk about some of the strategies, I did want to ask about what types of methodologies do you use? I mean, do you use kind of just kind of standard signal generation type models? Do you use econometrics? Do you use machine learning? What's the kind of methodological approach?
Yeah, well, the full breadth of those. So if I talk to how the business and in my little corner of it, how the industry has evolved. So as I said, with the roots in trend, what we found in trend, and I'm saying it like that, what we found, the happy accident, but we found this really useful, diversifying, liquid program that at the time within Man Group was being sold as a structured product to retail investors, very successfully by Man. And when we said this really needs to be in institutional investors' portfolios, they said, yeah, but that would require a fee cut. So that explains why Aspect exists, why we're not part of the then AHL. Of course, Man and AHL have gone on to be very successful and very useful in the institutional investor space. But the original model we discovered, or the original family of models, provides directional agnosticism. So they're indifferent to being long or short across a really broad range of assets. So you're exposing yourself to a huge variety of opportunities, diversifying from traditional equity and fixed income investments in a cash efficient format. So what's not to like, Bilal? Well, what's not to like is that the behaviors of trend can be it's both an episodic strategy. You can go through extended periods where there just are no opportunities and investors get bored and frustrated and lose confidence in it. It can also be volatile. So as the name describes, if you're following a trend and that trend suddenly reverses, it can have some sharp edge effects. So both our business and I think the industry has evolved a diversifying set of models to complement trend. and a couple of things, so you asked what's the methodology. I'd say the arc of history, as we evolved away from trend or evolved to complement trend, we very much focused on similar models where you could point to almost a behavioral underpinning. So, models like term structure, like seasonal effects, like relative value. These were often low traction, but broadly applicable, very persistent, albeit unpredictable models that we could put together into a much more stable portfolio to complement the trend efficacy, the trend utility. And then we've gone on from there. So we look for, in our macro team, we're looking to exploit econometric data, nowcasting, web scrape data, news parsing, trying to get an information advantage that gives you an econometric insight. We have a short-term trading team who use similar insights that the behavioral group, the trend group, use, but applied at a much shorter time scale. So you've got to be much, much, much more pedantic about your execution and intraday behaviors. And then you mentioned machine learning. That's a really interesting area for us, where we're exploring spaces, cross-market relationships that are invisible to the naked eye. To the trend researcher of 20 years ago, these are phenomena and opportunities that they couldn't have harvested. So that broad range of models gives us flexibility to come up with a number of different programs and products that we can offer investors. But almost more interestingly now, as investors have become more sophisticated and more, they're more interested in customizing, in cherry picking is the wrong word. That implies over optimization, but in selecting a combination of those models better to fulfill the utility that they're trying to solve for in their portfolio. That is, that's why I love what we're doing. The breadth of models and the ability to tailor these to satisfy individual client specifications. And that comes all the way back to the benefits of systematic versus discretionary, because I have an understanding of the model behaviors and can work with my investors to generate outcome driven portfolios.
And you
that was a mouthful. Sorry.
No, that's great. No, it's great. I mean, it's very comprehensive. You mentioned trend a number of times now, and up until a few years ago, trend returns weren't great. Across most asset classes. I mean, it depends which asset class you look at. But last year or two, it's done quite well, at least since COVID. So, I mean, is this just another example of how your momentum can have these phases of like nothing special, then suddenly it gives you great returns? Or I mean, how do you think about periods like this?
Yeah, and I'll just pick you up. You said trend returns weren't great. I think you're talking about a window of time. Historically, they've been extremely strong, and that sort of is to my point that over the period, I would say since the global financial crisis, we've been in an environment, a very controlled environment. You've had declining and near zero interest rates. You've had coordinated central bank intervention, and you've had sort of with the benefit of hindsight, I think we're going to see that was a benign financial environment and the anomaly, Bilal. So really, the way I view this is not that the trend models have deteriorated over time. Actually, it's that there was a paucity and a lack of opportunity over that window because we were in such a controlled, compressed environment. And the last 2 years is sort of coming out of that phase. So if you are more forward-looking, I think, as we look at where we sit now, we're sitting in a world of remarkable uncertainty. The interesting thing is actually how many of I was going to say trends, how many of the axes of diversification, opportunity sets, I can articulate now, all had their origins, have been bubbling up for quite some time. But it really, I guess it's sort of that perturbation that the pandemic unleashed has maybe unjammed the tectonic plates. I'm getting a little carried away with the language.
No,
But
it's good.
if you think about, where we are now in terms of, dispersion in inflation globally and the resulting central bank policies, we've got real differentials in how different geographies are dealing with this. That creates opportunities for one of my colleagues wrote a paper on the currency phoenix. So think about currency differentials. That's been a very strong sector recently after a period of really being in the doldrums for many, many years. Now, as we've got differential interest rate and growth prospects, there are strong opportunities that have manifested themselves across different currency sets. You've got energy insecurity, you've got commodity trends, which is both, food insecurity, but also the febrile geopolitical environment. You've got societal change, which is driving, lots of different supply and demands. You've got trade frictions underpinning, and all of these, Bilal, have created opportunities where it's hard to see how they land. It's hard to see what flows they will generate. And in the same way as 2022 really was the performance both of our strategies and of traditional assets was driven to a large extent by getting behind the Fed, getting behind where inflation was, and always playing catch up in terms of interest rates and generating flows on the back of unexpected hikes in interest rates. I think we have a much broader opportunity set across many different axes, whether it's interest rates, whether it's where the equity markets are going to go, currencies, commodities. There are a number of unclear flows that we are sitting on the verge of, and these family of broadly diversified strategies can take advantage of those. Directionally agnostic, broadly diversified, highly liquid. We're going to be able to harness those. So again, long-winded answer, but I'm extremely positive both about the performance potential of the strategy, but almost more importantly to my investors is its diversification utility within their portfolios. It's going to be providing very, very different performance characteristics to a traditional 60-40 portfolio, if anyone still has one of those.
And one fear I always have with building models is the fear that it'll get priced in, so to speak. Other people have the models, and suddenly there will be a deterioration in the performance of the model. I mean, how do you think about that?
Well, I'm thinking about you. One of my favorite books. I'm getting ahead of myself. Just tells the origin story of the work done by Daniel Kahneman and Amos Tversky, who were, as you know, behavioral psychologists. And what their work did was showed how our behavioral tendencies can dominate our view of, obviously my area of interest is how we view risk and reward. And what that highlights, Bilal, is that even if we understand what our biases are, we can't do anything about it. We still go out and buy insurance. We still tend to behave as herds. We rather than the trader maxim, cut your losses and run your profits. It's exactly the opposite of what your basic human instincts, the way we're wired, will tell us to do. I do continue to have confidence in certainly in the family of trend and behavioral models that they have sound underpinnings, because we as a species haven't evolved very much.
That's true. And you mentioned investors earlier. So, I mean, how do investors approach these systematic strategies? And you mentioned portfolio utility and so on. Obviously, a year or so ago, the 60-40 portfolio did really poorly on both sides of the of the assets there. Both bonds and equities underperformed.
Yep.
So I mean, how do investors approach this?
Well, the first place is to say increasingly interest or return of interest in the strategy. I mean, you put it well that it has been unimpressive, uninteresting for several years, and now it's garnering interest. And I think that it's taking time, because I wouldn't accuse my investors and the people we speak to of being performance chasers. They are trying to understand the utility of this diversification. So, but that's what's coming through. I would almost suggest that because of that coordinated central bank period, the zero interest rate environment, we've had a period, Bilal, where you frankly didn't need to diversify your portfolio. Diversification looked largely like I'll have some private equity to diversify my public equity allocations. That doesn't sound much like diversification. So I think we're now in an era where true portfolio diversification is once again extremely important to investors, to asset owners. You can't just rely on outsized returns from your growth stock portfolio and the insulating characteristics of bonds. You need true diversification. So that's what we do, and that's why the investors and consultants are increasingly interested in what we're doing, and why I think it's a very important component to add to investors' portfolios now.
And you've talked about the systematic strategies that you're drawn to, behavioral, trend, and such. The other type of systematic strategy that's quite common is carry.
Yeah.
So you haven't mentioned carry. So first of all, what are your thoughts on carry? Do you incorporate it in some way?
Yeah, I obliquely referred to it as term structure. So, and then I've also mentioned it in the context of currency behavior. So,
Yeah.
in an environment where we're seeing dispersion in growth prospects, in how different geographies are managing their differential inflation prospects, that's creating really strong opportunities for the carry strategy. Obviously, carry like trend. The good news is it's got behavioral underpinnings. The bad news is it's quite a sharp-edged strategy. So it has to be carefully risk managed and part of a portfolio of strategies.
Yeah. And, we've talked about individual strategies, but then at the portfolio level, I mean, how do you risk manage everything? I mean, what's the risk management approach? Is it done at the strategy level? Is it an aggregate level?
It's at all of those levels. I guess the overriding objective of our risk management is to get ahead of it. You want to control model behavior for unforeseen market eventualities, so that you're not put in a position of having to take big decisions under stress. So risk management, we talk to investors about having it built in to the model. The starting place is there's diversification, broad diversification within the program, both in terms of the assets that we trade. So any of these different programs will have hundreds to 200s or more different opportunity sets in there. So in the eventuality of illiquidity of one of those markets, that's not a good thing, but it's not a disaster. So broad diversification by model set. And then you're trying to understand each of these models has a particular failure case. So you want to understand that, you want to mitigate against it, you want to put limits on the portfolio. So every different model will have its own inbuilt risk management constraints, but then at the portfolio level, you just want to make sure that the risk the portfolio is taking, the risk you're taking in individual sectors, individual markets, your assumptions about correlations are all controlled, and understood. That's our sort of holistic view of risk management. Take the risks that we want to take, which will be directional, which will be an appropriately controlled level of leverage. Don't take the risks you don't want to take. So we manage the liquidity carefully. We know that we should be able to alter our positions, get out of any of these positions in a very short period of time. That's all part of the risk management process.
Yeah, that makes sense. And earlier, I mentioned machine learning. What I didn't mention was a specific area of AI, I suppose, large language models and ChatGPT. I mean, it's a very exciting area. And there's a lot of research coming out in that space. Is that something you've started to look at, or your team has started to look at?
Well, I think you'd be fairly Luddite to say no. So definitely the productivity gains of large language models for our for teams that are, that can use them in a controlled way. I think every business is wrestling with this. You don't want to just hand your your paper writers over to ChatGPT or your developers over to to a large language coding model, but it's useful. So it's useful across the business. We've been very thoughtful and careful about making sure that we protect our IP and that we don't make all of the obvious pitfalls of relying on it too much. But I'm stating the obvious here, that in the right hands, it's a useful amplifier. It's a useful augmenter of people's productivity if used carefully in the context. What it isn't, Bilal, is a panacea source of new models and insight into the data. So I've referred to it, we've had an effort of developing machine learning driven models for quite some time now, and we've stepped into that cautiously. So the underpinnings of the business are to want to offer systematic, repeatable, explicable models to our investors, and that's what we're all about. This is about providing transparency. My sales pitch is not, it's a black box, you're going to have to trust me, but I'm not going to tell you how it works. I want my investors to understand what the phenomena are that these different models are trying to capitalize on. So we stepped into our machine learning research requiring that we have an understanding of what's it finding? What are the intermediate layers? What are the relationships that it's identifying between the constrained data input sets? We didn't just throw an infinite amount of data at the model and see what came out. So again, long-winded way of saying we're very positive about what we're finding in that space, and as I said, cross-market and other relationships that are non-linear in the way that traditional trend research is linear. But large language models don't yet anyway lend themselves to rapid improvement in that space. They're useful. They're useful at increasing productivity, at parsing new data sets. But in terms of our machine learning model evolution, what the team tells me is the transformer model doesn't particularly lend itself to the kind of time series work that we're doing at the moment.
Yeah, and time series is a great comment you make. I find that there's a lot of machine learning and AI, experts and expertise, but within that, there's the time series element is often missing. Often, we hire lots of machine learning people from university and such, and they've never worked with time series half the time, which is just which obviously for finance is not great. So there's a big kind of learning that you have to sort of have. I think that's one of the interesting areas of machine learning, the kind of a lack of time series expertise.
Yeah, but I stress, with all of the excitement about this, it's one of the tools. That expression, to a man with a hammer, everything's a nail. If you suddenly, see the opportunity of machine learning and apply it to every area of your business, I think that way is fraught with danger. So for us, given who we are as a business and the models that we want to offer our investors and work with our investors to understand, the requirement for explicability is absolutely paramount.
Yeah. And we talked about teams actually. So one question I have for you is, I mean, how do you build your teams at Aspect, and how do you attract talent? How do you ensure the culture's the right culture for this scientific approach that you have?
I think, Bilal, when we started the business, having left Man and started Aspect with the belief that this approach warranted an allocation from every investor's portfolio around the world, we knew that the business had to have a culture of meritocracy, a culture of curiosity, a culture of collegiate learning. So those are some of the, my founding colleague, Eugene, wrote the culture document as one of the very first things we did when we sat down to start Aspect. And it still remains true today. It's on our intranet, and employees can look at that. And really, that's the important thing. I think we distinguish ourselves, or we differentiate ourselves by emphasizing the purpose of what it is we're doing, the fiduciary responsibility we feel for the returns we're generating, and the collaborative quasi-scientific. I say quasi-scientific because we both agreed that it isn't a hard science, but we build on one another's research. It doesn't mean that there's groupthink. We have different teams. I've alluded to the different approaches that these folks are taking, but they don't work in isolation. It's not an eat what you kill environment. We're all looking to learn from one another, to share insights, and to share data across the different domains. So, and the last thing is that, again, from day one, we started a charity committee. So there's also a culture of giving back, or of being more responsible to the community around us. Year before last, we achieved B Corp status. So much of that is the features that attract the people that come and work with Aspect. They are curious, they are driven, they are collegiate in how they want to learn, how they want to pursue their careers.
You mentioned B Corp there, just for the benefit of listeners who don't know what that means. Maybe you could explain what the B Corp status implies, or
Well, rather than be, it's a change in the Articles of Association that acknowledges the responsibility of the business, not only to its shareholders and its clients, but to a broader community, to its employees, to the community, and to be as sustainable a business as it can. And to achieve this status, there is a review process with many different criteria about how we run our business, and it's quite a high barrier to achieve. But given where we came from, it wasn't a complete diversion. In fact, it was one of our team members who said, given the way we've been running this business, this looks somewhat resonant with many of the qualities that we've espoused as a firm. So I'm not belittling how much work was involved in achieving that designation, but it was, if you will, a natural fit.
Yeah. And you still are involved in physics. So we've been at sort of Oxford University physics dinners together and such. I mean, in the physics domain right now, what excites you the most?
Ooh, gosh, how much time do you have, Bilal? As you rightly point out, I'm involved with riding shotgun, or spending time anyway with the academics at Oxford Physics, and it's like being a kid in a candy shop because of the work that they're doing. What are some of the obviously closer to finance, some of the quantum computing work that we've seen. Atmospheric and planetary physics is doing some seminal work towards measuring and mitigating climate change impacts. And the fundamental particle groups are just head spinning. Really, it's an honor to be able to spend time with these folks, and also it is an opportunity to talk to many of the graduates and give them my perspective anyway on what life in finance is like, because there is a natural conduit out of physics into finance, and I have an internal conflict. On the one hand, of course, we want the best physicists to join Aspect. On the other hand, I think this work that we're doing to develop our understanding of the world around us and improve how we can harness it, we should keep the best physicists in the academic sphere.
Actually, this leads me to one or two sort of personal questions I wanted to ask. Like, one would be, what advice would you give to somebody who's soon to leave university or is considering their life after university?
So you've heard me harp on, I think, the attributes of a scientific rigor in your training. It puts you in a good place. So I'm not saying you have to have it, but that is a really good attribute to start and shape your outlook on the world. And I would add to that curiosity. So even if you don't have a hard technical science background, it's just curiosity. I think somebody shared the anecdote that of the non-scientists, the highest proportion of folks in finance are historians. So there's a sort of natural curiosity of what are the relationships, what are the dynamics that have formed various narratives through history. So I would impress on people the importance of curiosity, the importance of challenging the status quo, and I think topically, I'd also say find something you love that makes a difference. And there I'm drawing the distinct, being a child of the 80s, the sort of get rich quick and then you can give back, I think leads to some bad outcomes. I think we should, all of our graduates should be, maybe do their national service or the equivalent thereof, that we need to have a much more community-minded approach to careers.
It makes sense. And in terms of books, I always like to ask my guests something about books. I mean, what are some of the books that really influence you, or books that you recommend to our listeners?
Well, I went short that question by referring to the. I do think in understanding why systematic models continue to have traction, especially the sort of family of behavioral and trend models, you understanding the work of Kahneman and Tversky is really important. So the most approachable way into that is the
Thinking Fast.
Well, that's actually Kahneman's book, and that's great. There's a Michael Lewis book called The Undoing Project, which I do recommend as a light but very insightful read.
Yeah. Okay. Great. Yeah, I'll definitely put those on the list. I haven't actually read that one before, The Undoing Project. I'll make sure to add that to my list. I mean, this is all great. I mean, we could go on and on, but I think maybe we should stop there. And what's the best way for people to follow you or the work that Aspect does?
Bilal, thank you. I think go to aspectcapital.com. We've got a lot of research there. We've got some videos of life at Aspect, and we discuss the various different research teams and capabilities and products that we offer.
Great. No, with that, thanks a lot, Marty, and good luck with all of your endeavors.
Super. I'm sure we'll meet again soon, Bilal. It's a real privilege, and thank you for inviting me.
Thank you.
All the best.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.